All right, listen, guys, I'm so excited to be making this video. Like, this is something that I've been pushing off because I've been so heads down building with OpenClaw. It has completely revolutionized the way that I'm approaching investing, and I'm literally pretty sure I'm going to take $10,000 and invest it in a new way that I wouldn't have even thought about before, all because I've built this insane system with OpenClaw, and I got to talk about what that is. Now, if you're brand new and you have no idea what OpenClaw even is, let me give you a brief rundown of it. OpenClaw is essentially AI agents. They're like employees that you can go out and hire, except they're extremely efficient and they just get the job done. Now, you might be a little bit like confused. AI agents, like maybe we're not there with technology. I will show you some of this stuff and your mind will be blown. But basically, how this works is I've got this Mac Mini right here. I literally, the day I heard about OpenClaw, ran out, bought this Mac Mini to get it all set up. And now on an isolated environment, actually over here on this computer, that is this Mac Mini. This dude, I named him Conrad. Conrad is now the CEO of my organization, and he is just an absolute beast. All right. Basically, you can think of it like any other employee that you hire. You want to onboard them. They get to know you, your business, the goals that you have. So I talked to him all about YouTube, all of my processes, and man, let me show you just the surface level before we get into the investing stuff of what this thing has done. So it literally went and built an entire org structure for me. While I sleep, this thing is doing work. Okay. This is what happens right now. I am the founder and creator. I make the content, I record. Conrad then looks at that content, distributes it on different mediums. He learns how to repurpose it for the newsletter. He's looking at different tweets that we could do with it. He's looking at all of these different things. Conrad himself realized that there was a gap in my business. I was doing a ton of research and all the script writing and building everything, right? So he then spawned 3 employees. One is Scout, who handles research for me. Literally, when I go to sleep, Scout is doing research. I had specific criteria for what I would research before. Now I've got an employee that's doing it while I sleep. I wake up to all of this research, can interpret it, can validate it, do all this stuff, make content around it. Absolutely freaking insane. Scout will then kick that stuff to Writer, who could then create newsletters out of it, create content, write YouTube video scripts, like all of these different things just from just AI. Like, and the AI is ever learning in this case. It's got unlimited memory. You could teach it all the stuff that you want to teach and just dial it the heck in. It's why this thing looks so good. Like literally you can see what's going on at all times. And I've got Architect who builds everything. Architect built this site, built everything you're seeing. He built all the investment stuff we're going to be talking about here soon. And, it's just insane, man. Like I'm geeking out over this stuff. I'd love to show you more. Maybe it's for a different video, but let's get into why this has revolutionized the way that I'm approaching investing. Okay. And this is something that we built as a team, me, Conrad, Scout, the Architect, all this stuff. And it's just nuts. So before I get into it, let's talk about one of the big problems that I have with investing. And that is honestly YouTubers. So I'm like in my own worst nightmare right now, because here I am, a YouTuber that talks about all these different investments and all the different things that I'm doing. And I don't really love that as a space in general, because it's really cloudy. It's a crowded area. People have different philosophies, all this different stuff going on. And it's hard to, whack through the noise here. So one thing that was frustrating to me is that you could go to one YouTuber, you could see Johnson & Johnson, and they might be like super excited saying, hey, this is a fantastic buying opportunity. You got to go all in on Johnson & Johnson. Look at the charts, look at all this data. It is just insane. Like this is the opportunity of a lifetime. And then you go to the next YouTube channel and oh my gosh, Johnson & Johnson is a nightmare. If you ever invest in this, you're just pissing your money away. Terrible decision. And honestly, when I found myself in those situations where I would go out, do research, I'd come to what I thought was a good analysis of it. Then I'd go and I'd hear what other people saying. I'm like, damn, well, that makes sense. Now I'm a little worried about this stuff. I realized that the issue wasn't the people online or the YouTubers themselves. It was me. It was that I didn't have a strict criteria that was set up in order to know if an investment was actually worth it for me. Enter OpenAI and this insane project that I've gone ahead and built. This is a stock screener, but I would like to coin that this is a stock screener on freaking steroids. Like, let me zoom in, give you a little bit better view here of what we're going to be covering. This is something that I created. It is the Dividend Stock Screener. It is a 9 criteria system for finding stocks worth owning. Now, I don't think this is publicly available yet, or I don't even know if I will make it publicly available. Maybe if there's enough interest, leave some comments down below. But how this was built is I did a ton of research into, well, you can see these different investors down here. I did a lot of research into these guys and picked what I thought was their absolute best criteria when they were selecting stocks. Okay. So there's a lot of research, a lot of time went into building this and the data behind it. So for Warren Buffett, basically his entire philosophy is built around buying exceptional businesses at fair prices. Return on equity is going to tell you if a business is truly exceptional. Debt to equity tells you if, it's financially bulletproof. Those are his philosophies. So I took return on invested capital, debt to equity, and revenue growth as the driving force behind some of the criteria. Okay. Peter Lynch, he coined the PEG ratio. He said that the PE alone is useless without knowing the growth rate. So you take the PE divided by the growth rate, and that's how you get the PEG, which is a single number that tells you whether you're paying a fair price for what you're getting. Okay. Then we've got this dude Chowder. This one's really interesting to me because it's just some random dude online. It's a pseudonym for him, an anonymous investor, and he was legendary on Seeking Alpha. He basically developed a simple formula. He took the dividend yield and he added the 5-year dividend growth rate, and then he got a single score from it. Okay. The community literally named this scoring system after him because of how effective it was. And I built it into this system. Then you've got David Fish, who's the creator of the Dividend Champions list. He literally manually was tracking every US company that had raised its dividend for 5+ consecutive years. He did this for an extremely long time. And so we've got the consecutive years growth element to what we're screening for. Then we've got Chuck Carnevale, and he is the founder of Fast Graphics. This dude is talking about how you could manipulate accounting, like the numbers that these businesses are reporting and stuff, but you cannot manipulate free cash flow. So we took that element of it and the payout ratio, and we developed 9 strict criteria for what this is. Now, you might notice something weird. This doesn't take into account price appreciation on the actual stock itself. And there's a strict reason why, or a specific reason why I should say. This is for dividend income. This is for dividend investing. I think it helps identify some of the best dividend investments that you can make. However, it's not a growth-oriented machine. I actually plan to build one out similarly to this, but I want to talk about it. These are the 9 criterias down here. We can scroll through it. So here's what we're looking for with this. First, their dividend growth rate for 5 years has to be above 7%. That literally means that they're doubling their dividend payment every 10 years. So that growth is just awesome. Then we want 5 years of consecutive dividend growth. I mean, anybody can make that one-time dividend payment, but if you're consistently doing it, the longer these companies are consistent, they want to get into that dividend king, the dividend aristocrat list. They want to just make sure they prioritize that they continue paying these dividends. Next, we've got the payout ratio. I try to keep that below 65% because if a company's paying like 90% of their earnings, well, one bad quarter could completely wipe that dividend payment, could put them under it and like screw over everybody. So they would just slash it. Things wouldn't be looking good, and something to be aware of. Now, because earnings can be manipulated, we use free cash flow as just an added layer of protection. So we try to keep that below 75%. It's a very similar reason to the payout ratio though. Then we screen for return on invested capital, which should be above or equal to 15%. That is how efficiently a company is turning every dollar of capital, debt, and equity combined into profit. Then we've got debt to equity. Okay, a company that's drowning in debt, they have to use cash flow to pay their interest instead of growing the dividend. So when rates go up or the business slows down, high debt companies get crushed. So under 1x means that they're not really over leveraged. Then I like looking at the revenue growth for the last 3 years. It doesn't have to be anything insanely massive, but if you're not growing your revenue, your business likely isn't growing, which means how are you going to grow your dividend payment? That's what I care about in this scenario. So just another good criteria. And then we get into the PE ratio stuff that I was talking about and why PEG is a little bit more important to me. So like just as a use case here, 30 sounds expensive for a PE ratio, but the company might be growing at 30% per year and it wouldn't show up in that number. A PE ratio of 15 sounds pretty cheap, like you could get in until you learn that it might be growing at just 3% per year. So the PEG ratio catches both of these things, and anything under 2 means that you're paying a fair price relative to the growth. And then we got the chowder number, which again, this is like the ultimate shortcut for dividend investing. A stock with a 3% yield growing at 10% per year scores a 13. That's a solid pick. But a stock yielding 1% growing at 5% scores a 6, which would mean it's not really worth it. So this one number tells you if the income plus growth combo is good enough. Okay, so now comes the really fun part, and it's actually putting this to use. Now, yes, I could go ask my little AI employees to go and screen a whole bunch of stocks, but I like to verify things. I like to do it for myself. And so let's just look at one for an example, Johnson & Johnson. We used them as an example earlier, and you're going to notice that, hey, they only pass 6 of the 9 criteria. Now, the cool thing about this is it dives a little bit deeper. It tells you in each section why each thing failed. And so you get a better idea. So literally this one, there's 2 reasons why I think it should have passed some of the other categories, but this is a strict rule set, so it's tough to say that it should have. Now, the first of which is that the 5-year growth calculation was affected by the Kenvue spinoff in 2023. So this would be a lot closer to what we're looking for, and it would probably pass that if it wasn't for that, fundamental shift in the company. Then you get to something like the free cash flow, and you see that it's 75.3 when we're looking for 75%. So it's just right on the cusp of that right there. So you can still identify some good stocks, even when they're really dang close to it. And then where this one fails is that chowder number that we were talking about before. So that's just one example. Then you got stuff where we could look at like some of the all-time favorite investments Warren Buffett has. So if we open up KO, Coca-Cola, hey, 3 out of 9. What's interesting about Coca-Cola is they're not really growing as much as you'd think with these categories, but they are looking to just keep paying out dividends. It's just an interesting little setup here. So they're failing on that dividend growth rate. They're failing on the payout ratio. Their free cash flow is way too high. Their debt to equity is a little bit too high. I mean, it's basically, it's telling us what we need to do here. Verify if elevated by acquisition debt, buybacks, or captive finance arm before dismissing. So we would want to do a little bit deeper dive into this. I think this would be closer to passing. Then you got the PEG ratio, which is very close, to be honest, like 2.47 there. And then the chowder number is off again. So that's just like some stuff that you look at with this. It's helpful to go and screen it, but this isn't something that I'd be necessarily inspired by. I'd be like way more into something like J&J. Now, as I mentioned before, I think I did, there's only one stock that meets all the criteria that I've found so far, and I'm still screening a bunch of different ones, but I feel like I've done hundreds of stocks at this point. And we'll talk about that. I want you to guess what you think it is. I don't think anybody could really guess what it is off the top of your head, but let's look at something like Microsoft, because this is one that I'm actually really interested in. It meets most of the criteria and just fails on the chowder number. Now, this is something that, again, is very hard to find one that hits every criteria. So this is something that I'd be considering. Now, I'm going to go ahead and click add Microsoft to watch list. You can make a note here if you want, which is cool. But then you can come and see, hey, this is a score of an 89 of this criteria. Now, 89, almost an A minus, like could be something worth considering. So I'm going to build out my watch list. But let's look at the one stock that passes every single criteria on this. And I would have never thought so, but it's Allstate. Now, Allstate's a very interesting one because like they were, I think, affected by all the California fires that went on in the past. Like they've gone through restructuring, reorganization, all of this stuff that's going on, and their numbers are looking really solid as a dividend payer. Now, that's just something I keep my eye on here. I didn't mention, but like the breakdown of this page is really cool too, where you have all the information up here. You can scroll down and then you can see how it's appreciating over time. But you can do a whole bunch of different stocks. You can look at things like Apple here, and you'll notice that they're 5 out of 9. Again, they're not really a dividend player. You could go into like Tesla. You'll see they're 1 out of 9, definitely not a dividend player. It's just cool because you can bounce around. You can add things to your watch list. You can go ahead and, build it out that way. Now, this is all stuff that I'm trying to work on and trying to figure out like, hey, how can I make stuff like this more publicly available? And I got to be honest with you, like I'm just working through doing stuff with this and learning a ton about this AI agent stuff, a ton about OpenClaw, but this is fundamentally changing the way that I'm investing. And I'm literally going to build a brand new dividend portfolio based off this information. And I'm looking to to invest about $10,000 into it just to start it off, kick it off the ground, and continue building my dividend income. Now, I'm super excited for that. In the future, what I'm going to do is I am going to build a growth machine, something that I'm able to target and look at what are the best growth investors, what have they done, how can we screen different growth opportunities similar to the criteria that they were using, and build it out in a super automated, like nice, clean way that you can view everything. So this is just the very early days of all this stuff. I'm going to be talking about it all in my newsletter as well, so make sure you're subscribed to that right here. If you guys took anything away from this video, it would mean a ton if you left it a like. And if you want to see the next couple videos, I'll probably talk about that watch list, what I'm actually investing in, and how much I'm putting into each of these stocks. But I'm going to be doing a ton of different research off screen, trying to figure out some of this stuff. I had to make this video. I'm just getting over the sickness. There's so many cool things that I'm getting into right now, and this is just the cusp of what's to come. So make sure you're subscribed to the channel. Thanks for checking it out, and have a great day.